market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg has learned that Germany is set to approve 29 military procurement contracts worth a record 52 billion euros. Now, it's part of the government's push to transform its military into Europe's strongest conventional army. Let's bring in Bloomberg's chief Europe correspondent, Oliver Crook. Ollie, good morning. So what more do we know about these contracts, and what message is it trying to send?
The message that it sends is that the Germans are putting their money where their mouth is. This is part of the initial program that was launched by the former Chancellor Olaf Scholz, the so-called Zeitenwende turning point speech that he gave after the Russian invasion of Ukraine. And this is Friedrich Merz really picking up the mantle and really executing on some of those ambitions. We should say $52 billion is the number of orders that have been approved now, or were likely going to be approved for the German military. To put that into context, Francine, in 2021, the year before the Russian invasion of Ukraine, the Germans spent only 47 billion euros on their entire military budget for the whole year. So this is one sort of procurement a go-ahead by the Bundestag, dwarfing all of the spending formerly of the military before the war and the invasion. What we get in terms of the actual money for the gear is 22 billion on basic gear, about 4 billion on infantry vehicles. You can see there 3 billion on interceptor missiles, and almost 2 billion euros on surveillance satellites. I think this comes, Francine, at a time when we are seeing the American foreign diplomacy. We had that national security document that came out on Friday, really wanting to see the Europeans take more responsibility for their own defense. And this is part of the reason that the Germans have been called repeatedly by U.S. officials a model ally, because they're really executing on those ambitions and really what the United States would like to see. Now, one of the issues that the Germans are going to have, yes, the money is there and they're spending it, and we should say that that is really being represented on the stock 600 right now. Most of the biggest gainers on the stock 600 this morning are arms manufacturers, many of them German, is how are they going to get the number of personnel that they need in the military. The German military only has 180,000 active duty personnel. The Russians have, for example, over 1 million. The Ukrainians almost 1 million. That is going to be the next step for the military build out for the Germans.
Yeah, and Ollie, I mean, this comes as Europe nears a deal on using frozen Russian assets to fund Ukraine. European leaders seem increasingly confident that they'll be able to do so, before the end of the year following the talks in London.
Absolutely. And those are talks that were held by President Zelensky, Emmanuel Macron, Keir Starmer, and Friedrich Merz. And we should say that the sort of biggest impediment to grasping those assets and the reparations laws has been Belgium. And we've not really heard anything from the Belgian Prime Minister over the last couple of days that suggests that his position has changed. That being said, those statements were made after that meeting that included Friedrich Merz. Friedrich Merz had met with the Belgian Prime Minister here in Brussels on Friday, potentially had some success in lobbying him. And really, this is going to be for the European leaders to discuss over the next 2 weeks. They will be meeting here in Brussels in about 10 days' time. And that really is seen for many as the last moment for the Europeans to make consensus and to get moving on this reparations laws. And we should say, Francine, the sort of importance of getting that 90 billion euros to Ukraine is absolutely fundamental. When I spoke to Zelensky a couple of weeks ago, he said for them, this is a matter of survival. And for the Europeans, it may be a way to get them back at the negotiating table in these conversations with the United States on Russia and Ukraine.
Ollie, thank you so much. Bloomberg's chief Europe correspondent, Oliver Crook. Now, President Donald Trump says that Nvidia has permission to ship its H200 AI chips to China in exchange for 25% surcharge. The chip maker could now potentially regain billions of dollars in lost business from a key global market. Well, Bloomberg's Tom McKenzie is here with the very latest. Tom, so great to see you. So first of all, how significant is this for Nvidia?
It is very significant. It's the first time we've seen in the last few years, and you saw it under the Biden administration and then into the second Trump administration, a continuing ratcheting up of export controls on the hardware and software that is available and can be shipped into the Chinese market. So this is the first time we've taken a step back in terms of those restrictions, with the H200 being an AI chip that has significant capability and is very different to the H20. The H20 was specifically designed for the Chinese market and was therefore allowed to be shipped in to China. It never really got there because the Chinese, or at least in recent times, because the Chinese authorities themselves discouraged their own companies from buying the H20. The H200 is a far more powerful chip. It was just the last generation prior to the Blackwell, which is the AI accelerator that the likes of OpenAI and other hyperscalers currently use. So we would give China capabilities it currently doesn't have at a time when China's own chip producers not only are a generation behind, but also are not able to produce the number of chips that China's own company needs. The key question is, will China accept these H200s? And also, what's the Treasury going to do with that 25% take?
So, Tom, do we have any idea of what demand will look like in China?
Well, potentially the demand is really significant, again, because China's own chip makers are behind in the technology and also can't produce as many chips as they need. So you've got companies like Cambricon, you've got companies like Moore's Threads, and you've got companies like HiSilicon, which sits within Huawei, that are the key leaders in terms of turning out and designing AI chips that can on some levels compete with their US counterparts. But again, they are behind on the technology and they are not producing as many chips as they need. So really, we have to watch for Beijing's response. Do they adjust their rhetoric, their jawboning of Chinese companies and suggest that they are able to take shipments of these much more powerful chips to allow them to build and continue to innovate? And that is really where we're watching now, I think, is how Beijing responds to this. But it's a clear, from President Trump's side, it's a clear concession from the US as he thinks about his trip to Beijing in around April of next year.
Yeah, and he's possibly, thinking of a deal. Tom, thank you so much. Tom McKenzie there with the very latest on Nvidia. Now, U.S. Treasury yields edging higher. Traders growing anxious over the pace of easing by the Fed. With us now, Alexandra Wilson-Elizondo, the co-chief investment officer of multi-asset solutions at Goldman Sachs Asset Management. Alexandra, thank you so much for joining us. I mean, what a day to have you on. What will the Fed do next?
So, we're expecting a hawkish cut from the Fed. That's, nothing new in that. In fact, that's what the market's expecting. I think what's more important is to focus on the dots for next year. And then any comments as it relates to the balance sheet, anything that's interpreted by the market as a liquidity injection in the system. Yeah. So you could, even with them being hawkish, you could still see risk asset continue to perform on the back of any announcement like that.
Do you see, Alexandra, just the economy deteriorating, especially the labor market, into 2026?
I mean, we expect to see pockets of weakness, and we have. And in fact, we're expecting Chair Powell to keep maximum optionality in front of next week's job data, which will be critical because they are still very data dependent. But holistically for the year, we're still expecting to see above trend growth, mainly driven by fiscal stimulus, as well as, continued CapEx spend from the AI trade. But in terms of markets, we're not expecting a linear upward trajectory as it relates to risk assets. In fact, we expect to see some volatility. Definitely
across equities?
Across equities. So definitely not calling, a top. We still see, room for continued performance, but the margin of error is a lot tighter given where valuations are. And then, previous guests were speaking to the global duration trade and how much rates are moving upwards. And we just think that there's more room for, macro to be repriced, a higher dispersion of macro across the board.
Do you worry about AI valuations? So when you're intimating they're priced to perfection, so is it going to be pockets of air being let out, but then they increase again, or could we actually see a fundamental correction?
I think there's going to be continued dispersion amongst names. And this is a really important week as well for earnings. We see a lot of the CapEx ecosystem announcing this week. And some of the things we're really focused on are actually CapEx plans. In particular, you've seen in credit markets a response to the $1.5 trillion that's being expected to be issued over the next 5 years. And so we're really closely watching some CDS markets, actually not for underperformance, but actually for some outperformance this week, just given if you get any announcements as it relates to GPU-backed issuance, some more transparency and clarity. But it'll be a key focus point for us.
How do you invest across the world? When you look at U.S. exceptionalism, we talk about it, waning a little bit, but actually equities are still performing very well.
Yeah, they are performing very well. And, we don't see a stop to the U.S. exceptionalism trade, but we do have more diversification in our portfolios, and whether that's across the U.S., Europe, but increasingly towards EM. In fact, we're very bullish on India, just given a lot of the, government focus, the GDP trajectory, but also, just more of a productivity gain and better performance from equities over the next year.
Is this because of the EM discount?
Definitely. Yeah. So in some cases, you're seeing the EM discount being, up to 2 standard deviations cheaper than normal. But, we still see not just the pricing, but there's a lot of fundamental tailwinds in some of the areas. And some spaces you've seen tremendous bid from retail, in particular areas like Korea, that can continue. And we expect that to, expand more across the globe.
Alexandra, as we look into like a little bit backward looking at 2025, you had these geopolitical tensions that are coming back at the forefront. They haven't really played out in markets. I guess at the margins you could see a little bit of an impact on oil. Do you expect more of the same in 2026?
I mean, from a geopolitical angle, we're actually focused on most announcements have been positive on the margin. And so increasingly it's about, what concessions are made, what negotiations are taking place. In fact, you were talking about some of the Nvidia announcement this morning. So we see a lot of room for positive trajectory and just knowing where that specifically might play out in sectors.
I mean, we're trying to figure out with Tom exactly how, the Nvidia chips sale to China was going to play out. Any thoughts on China overall? A lot of it is deflationary, but then we're also, potentially expecting quite a lot of stimulus in 2026.
Yeah, I mean, we've re-upped our forecast for GDP growth, especially on, how much the export announcements have increased. And we're on our, third 5-year plan, but it seems to be quite pragmatic. It obviously puts a little bit of a hindrance on European outperformance, just given it could slow down growth. But more holistically, we're pretty bullish, but we're also, cautious. We know that there's a lot of capital that can be put to work, especially because people have been underweight China for some time. But again, it's still, there's, the geopolitics haven't been completely resolved, and there's, some pockets of volatility to be expected on a go forward.
Do you like, equities in Europe? And is it very either sector dependent or actually country dependent?
A little bit of both, to be fair. We're expecting some stealth performance, so nothing aggressive, nothing like we saw in the first quarter of this year. In fact, we've seen less retail buying in Europe, more of an institutional focus. But we do still expect, Germany and the fiscal plans that you're continuing to see momentum behind to continue to put some thrust behind European equities. It just doesn't have the same momentum in terms of technicals as other markets do.
I mean, does the consumer hold up both in Europe and the U.S.? Yeah,
in fact, we expect the consumer to be better in the U.S. given some of the tax stimulus. And that is a big driver of our GDP forecast.
I mean, another, the big theme for 2025 was, of course, Liberation Day, trade and tariffs, and it feels like the market's kind of largely overlooked some of the concerns into 2026. Do they continue to just look through it?
So it's interesting. If you look at most of the macro calls, they're pretty consistent. And from our perspective, just given some of the valuation, some later cycle dynamics, this is the exact kind of market that you put some tail hedges into your portfolio. We do like, for risk, owning the front end of the yield curve. And in fact, most of the commentary recently has been how auctions aren't performing and duration is trading off. But you saw, yesterday, the 3-year Treasury auction was pretty incredible. In fact, I think it was, the second best in terms of, non-bank takedown. So we continue to think that there's a lot of different pockets of opportunity, especially just given where options and vol are priced, to put some hedges into the portfolio.
Alexandra, thank you so much for joining us. Alexandra Wilson-Elizondo, there, co-chief investment officer at Multi-Asset Solutions for Goldman Sachs Asset Management. Now, coming up, the French Prime Minister faces a key budget vote. We'll discuss all of that with an economist from Jefferies. This is Bloomberg.
Tomorrow, the Fed decides.
There are credible arguments to cut interest rates. Equally, there are credible arguments to do absolutely nothing.
I think the Fed believes that this is a risk management exercise.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
You wonder at this point how much the Fed is between a rock and a hard place.
There's going to be a lot of hyperventilation about this.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
If inflation continues to be persistent and looks like it is not coming back down towards the board's target, then I think that does raise questions about how tight financial conditions are, and the board might have to consider whether or not it's appropriate to keep interest rates where they are, or in fact at some point raise them. But I wouldn't put a timing on that. It's going to be a meeting by meeting decision.
The Australian Central Bank Governor there, Michelle Bullock. Now, the French Prime Minister faces a crucial vote on the social security budget today, with risks reigniting political turbulence. The outcome is highly uncertain, as previous votes passed by narrow margins. Rejection would be a serious blow for Sébastien Lecornu. Well, let's bring in Modupe Adegbembo, economist at Jefferies. Modupe, thank you for joining us. I mean, it feels like this is a story that's going on and on and on, and it's unclear what needs to happen for a budget to be able to pass.
Yeah, no, exactly. It feels like Groundhog Day. We've seen this many, many times. And what I think is quite interesting is we've already seen the Socialist Party leader tell his party to back the social security bill. So, look, I think we could have a narrow kind of, once again, a narrow approval of this bill. But it means that going forward, we still have this uncertainty. And that's why we remain negative on the French outlook. Because even if we limp forward, these underlying structural issues remain there. And also it means that the kind of fiscal consolidation that France needs to deliver is becoming a lot more challenging.
Is it just difficult in general for most European countries? I know there was a lot of concerns about Chancellor Merz in Germany. Then today we have, they're actually going for contracts and quite a lot of defense spending. But what looks good in Europe right now from an economic point of view?
So I think the challenge for Europe at the moment has been that growth just overall has been lower. And of course, we still have the lingering hit from the kind of European gas crisis. But what we're seeing in Europe is that, particularly in Germany, there is some kind of bright sparks when you think about the level of government spending that Germany are set to embark on and have already started. That is really big. And I think that can have a significant impact on the German economy, but also spill over as well to other areas of Europe, which can help to build this kind of revival. But as you say there, the kind of political uncertainties make it really, really challenging to deliver on that.
Yeah. Especially after the White House got this white paper or this paper out on Friday, which says Europe is a little bit of a mess. I don't know whether it changes the perspective of politicians of what they need to do economically to make sure that they are resilient, deal with the debt, but also spend enough on defense and budget.
I think it's challenging because we're slowly seeing the kind of transatlantic relationship shift, and I think that paper kind of sets it out quite clearly. But if you think about it maybe from a positive perspective, I think it could push European leaders to do more and to understand that they need to do more to kind of support their own economies. So that's one thing that we think could be positive. And if you think about what Germany have done with the infrastructure spending, that's taken a long-standing issue and trying to deal with some solutions. The next challenge will be on delivery, of course, and I think markets and investors will be really, really focused on next year. Do we actually see the fruits of those sorts of investments? But at least the kind of plan, I think, is a really, really good start.
But when you look at some of the central banks that have been supporting a lot of equities through this year, what happens in 2026? Are we going to see more of a divergence with, for example, between the ECB, the Fed and the BOE?
So I think it's interesting because, at least starting from the ECB, we've had some interesting comments, at least from Schnabel, suggesting that, the next move from the ECB might be a hike. And actually, I would say we don't agree with that view. I actually think that the ECB is likely to remain on hold throughout all of 2026. But if anything, I see the risks skewed to the downside. When you look at the inflation outlook in the Eurozone, we see it below target for 2026 and 2027 as well. So kind of lower inflationary pressures there. But then you also think about some of the things around kind of trade diversion, demographic trends, and potentially AI as well. But all of these things weigh on inflation to the downside. So I think we're less hawkish in that sense. But when we look at other central banks as well, I think in the Bank of England, or for the Bank of England, rates are already high. So I think we would all agree that rates remain restrictive in the UK. And there's a lot more for the Bank of England to do in terms of bringing rates down towards neutral, maybe even slightly below, because ultimately I think that growth in the UK could disappoint, and that could push the Bank of England to cut more than markets are currently pricing.
And this would be, has the Bank of England just been a little bit too slow to cutting, or is it because there's, also, I guess, domestic dynamics that complicate an extra layer for the Bank of England?
I think you have to at least see it within that context that there are slightly different domestic dynamics in the UK. Even when you look at spot inflation in the UK, it is still high, well above the Bank of England's target if you compare to the Eurozone, where inflation is essentially at target. So it is a slightly different kind of picture. And so I think the Bank of England has been responding to that difference. But what I think we'll see next year is that inflation will take quite a significant step down lower, and especially some of the policies that we saw the government implement in the budget that actually helps the near-term inflation trajectory. So that is helpful. And then when I think you take that alongside some of the weakness in growth that we're seeing on the UK side, if you look at some of the smaller pieces of data that came out last week, so the Bank of England's decision maker panel was quite weak, at least on the employment side, and the construction PMI. All of those things, and they're not great indicators, for growth and inflation dynamics going forward, but it just does mean that the Bank of England can do a bit more, I think, on the monetary policy side.
Are we going to see a lot more volatility into 2026? 2025, actually, we ended at almost where we started, but it has been a bit of a roller coaster, right?
Yes, indeed. No, it has been a very, very volatile year. And I do think that at least the way I see it, at least, some of the macro drivers also do support some more volatility, particularly on the fiscal side. I think we've talked about some of the politics in France, haven't necessarily touched on some of the politics in the UK, but I think those kind of factors will continue across Europe and in the US as well. And those are some of the things that I think could really, really drive volatility in markets. But I would say that overall we are positive on kind of risky assets, and we think that the economic backdrop, even though in some ways it is deteriorating, I don't think it's a significant deterioration in a way that would put any issue. So I think that is supportive.
What do you see dollar doing? Will it weaken further?
So I think it's interesting. I think we could continue to see a weakening in dollar, and that's actually one of the things that we think could also induce the European Central Bank to cut rates, actually, because if you think about seeing a further weakening in the dollar, we haven't yet heard about the confirmation of who the next Fed chair will be. I think some of those challenges around whether it will be someone who maybe will cut rates faster than markets feel is necessary, or potentially the economic dynamics suggest would be necessary. If we have someone who's extremely dovish, that would be negative for the dollar. And I think that also would have impacts on other countries as well, other countries' central banks.
Thank you so much, Modupe Adegbembo, their economist at Jefferies. Now, we have a couple of things we need to watch out for. First of all, the markets, all eyes on the Fed this week. There's also a couple of other things that we're watching out for, which is exactly what's happening in Europe. So first of all, stocks rising modestly. Stocks posting some of these small gains. I don't know whether we have a market board. We'll get to that in a second. Small gains while bond yields hovering near Monday's highs. Again, traders actually refraining from making big bets ahead of a Federal Reserve decision. Then we have BMW naming Milan Nedeljkovic as CEO from May 14th, 2026. We found out today that Oliver Zipse will step down at the end of May 2026. So again, quite a lot going on. We'll spend a bit of time also talking about Ukraine. When it comes to Ukraine, Europe seems to be nearing a deal on the Russian assets after these talks that we had in London. Ukraine's allies are under growing pressure to find fresh sources of financing after U.S. President Donald Trump's administration last Friday largely stopped aid to the war-ravaged country. Coming up, our stress tests, the way forward to alleviate concerns in the private credit sector. We'll discuss all of this with the CEO of Arcmont Asset Management, Anthony Fobel. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Germany seeks to transform its military with a record €52 billion defense spending package. This comes as Ukraine's president says there's still no deal to end the war. Nvidia wins President Trump's approval to sell more powerful H200 chips to China, despite concerns that it could undermine U.S. national security. Plus, family drama. Paramount enlists the help of President Trump's son-in-law as it launches a hostile bid for Warner Brothers just days after it agreed a deal with Netflix. Now, regulators in the U.S. are being urged to conduct stress tests on the private credit market, warning the bankruptcies of companies such as Tricolor and First Brands finance group are just the tip of the iceberg. The Bank of England is already evaluating how the private credit industry would respond to financial stress. Well, joining us now is Anthony Fobel, the chief executive of Arcmont Asset Management. Anthony, thank you so much for joining us. So first of all, I mean, this was quite a big development, actually. What do you think about the Bank of England's plans for a stress test of private markets?
Yes, I mean, I think we think it's a very good thing. Clearly, it's a review of the broader financial markets, so liquid markets and private markets. And really, as one of the founders of the private credit industry in Europe, we actually volunteered to participate in this exercise. And really, I suppose it gives us an opportunity to demonstrate what we think has been an extremely resilient asset class over really the last 15 years.
But I guess as a private credit becomes even more established as an asset class, what are the, I guess, pitfalls or the things that you worry about for your industry?
Yes, I mean, ironically, regulation is not one of them, because generally I think private credit has been seen as a force for good. If you cast your mind back to the financial crisis, really all financing was either provided by banks or the liquid markets, and the regulators have very much moved away from that and encouraged private markets and private credit to come in and provide necessary financing, perhaps at times when either banks or the liquid markets are not able to respond.
Is it resilient enough? Or, again, it's really impossible to know what's in some of these black boxes.
Yes, I mean, I would like to think it is. I mean, clearly, if you think about the investors of private credit, they are the leading pension funds and insurance companies globally, and they certainly put us through pretty rigorous tests before they choose to invest in us. And I think one of the trends we're seeing, as you alluded to, is a growth in private credit. And I don't think insurance companies and pension funds and sovereign wealth funds would be doing that if they weren't very happy with the returns that we've generated and the resilience we've demonstrated through some pretty interesting economic and political times.
Anthony, has the rise of AI made you more cautious about lending, for example, to software firms or in the software space?
Yes, I mean, that's clearly a theme that we look at very intensively. I think over the last 15, 20 years, there are always themes that might cause a disruption in the market. We are actually, as a sector, quite heavily focused on software and IT services. But we do think that actually most of the businesses we invest in should be pretty robust. Right. I mean, interestingly enough, it's just an exercise that we and a lot of our peers have been carrying out, really bringing in experts just to not only look at our current portfolios to make sure that they will be robust in those circumstances, but also to help us educate us, to the extent anyone is an expert, on some of the investment themes that we need to be mindful of as we think about future investments.
Do you see a danger of AI being in a bubble, full stop, and so anything also that's private will be touched if it suddenly drops?
I don't necessarily think so. I think if you get a significant public market correction, inevitably that will have some impact on the equity valuations in the private markets. But we are very much at the debt end of the spectrum. We are boring lenders, and really what we focus on is, does the business has sufficient cash flow to service our interest and ultimately repay the debt? So it's a lower threshold.
I don't believe that for 1 second. Otherwise, we wouldn't have you on TV. What do you worry about how, if you look at the algorithm or actually mathematics that you use to market things, is there anything that could change significantly in the next 12 months?
Certainly, I wouldn't say in the next 12 months. The two things that always concern us are very heavy recessions. I mean, actually, one of the reasons why we welcome this Bank of England exercise is most of us, when we do our investment theses, always look at the loans having to survive a normal type recession. Generally, you're making 7-year loans, so it's a pretty sensible thing to do to assume that you will go through a recession. I think GFC-type recessions obviously put additional stress, so that would be a concern, but I don't think that's in anyone's immediate forecast in the next 12 months.
No, but there has been a slowdown in private equity activity overall. So what does this mean for leverage buyouts, but also financing bolt-in acquisitions?
Yes, there clearly has been a slowdown over the last 2 to 3 years, although interestingly enough, we've seen a significant, probably a 30 to 40% pickup in private equity deals during the course of 2025. And as we look at our pipeline going into 2026, we're seeing a very active private equity market. And I think a lot of that is driven by the fact that financing costs have come down. but also public market valuations make it a better time for private equity firms to exit deals and do new deals. So actually, we've seen a significant pickup in private equity activity, and we've seen a corresponding pickup in our own activity as well.
Blue Owl had to cancel its plan to merge a public-private credit fund. What does it tell us more broadly about individual and retail investor interest in private credit?
Yes, I don't think that was quite specific to those particular circumstances. I think your point is a good one, which is generally we are seeing more appetite from retail for private credit. I think that's very much driven by the US, where investors typically are more active than Europe. But I would emphasize at the moment this market is very much open to professional investors rather than mass retail. But we support that. I mean, just as we've seen a significant growth by institutions coming into the asset class, we think that appropriately qualified retail investors should also have access to the asset class, and I think that will continue to grow.
Anthony, thank you so much for joining us. Anthony Fobel, their chief executive of Arcmont Asset Management. Now, President Trump's son-in-law has emerged as a player in the fight for Warner Brothers Discovery after Paramount launched a hostile $30 a share cash takeover bid. It comes days after the company agreed to a deal with Netflix, while Bloomberg's deals reporter Manuel Baigori joins us from Hong Kong. So, Manuel, what can you tell us about Jared Kushner's involvement in this hostile bid?
Francine, another day, another twist on this fascinating saga, the potential acquisition of Warner Brothers. Yes, Jared Kushner seems to be one of the parties, one of the backers involved in Paramount's hostile bid. Was disclosed, as we've seen yesterday, and has unfolded into a potential bidding war between Netflix and Paramount. Kushner's involvement is definitely remarkable. He was also, through his firm Affinity, was also involved in the previous mega deal of Electronic Arts, the take private as well, in the tech space earlier in the year. So this is another high-profile deal in which we see his name as one of the key potential backers. And it's not only him and his firm. We are seeing other high-profile investors in there, including some sovereign wealth funds from the Middle East, also Apollo, the alternative asset manager, lots of banks providing financing. Definitely a fascinating saga here that remains to be seen how it's going to unfold, because now everybody obviously expect what Warner Brothers will say in response to this offer being made public, and also potentially what Netflix next move might be as well.
So, Manuel, where does this leave the bidding war?
Yes, Francine. So as in any bidding war, everybody is going to be very tactical about the next move. I think the next few days will be key. Obviously, now Warner Brothers has 10 days to respond to Paramount's offer after being made public. Obviously, two offers, two different proposals on the table. Netflix, obviously, there is cash and shares for some of the assets. Obviously, then we've got Paramount, which is $30 all in cash for the whole company. What the response for Warner Brothers and the shareholders will be critical here, right? Whether they prefer one bid versus the other, and what the pressures might be for each of the company on their next moves remains to be seen. Also, the political backdrop. Right. Donald Trump has been quite vocal about the idea that a potential deal by Netflix could also raise antitrust issues or concerns, given the big market share that the combined entity might have. So the next few days, next few weeks will be very, very important, and each company obviously will keep the cards close to their chest as they try to analyze the next moves.
All right, Manuel, thank you. Bloomberg's deals reporter Manuel Baigori. Now, the European Union has begun an antitrust investigation into whether Google has abused its dominance by using its own AI tools to squeeze out competition. Now, the Commission is also looking into how much AI overviews are based on web publishers' content and whether they're being paid appropriately for it. Google has not yet responded to our request for comment. A U.S. judge has ruled that President Trump's executive order banning new wind projects is illegal. The ruling says the president's January order was arbitrary and capricious and contrary to law, siding with more than a dozen U.S. states and a clean energy group. Now, the order froze dozens of projects, including large-scale installations planned off the eastern seaboard. And the U.S. Supreme Court has signaled its willingness to give the president more control over a traditionally independent federal agency. In a hearing on Monday, justices suggested they will let Trump permanently remove Rebecca Kelly Slaughter from the Federal Reserve Commission or Federal Trade Commission, despite a law saying commissioners can be fired only for specified reasons. Now, the ruling could undercut the independence of the Federal Reserve, but conservative Justice Brett Kavanaugh has indicated he would reinforce a carve-out the court created for the central bank back in May. Coming up, we get an insight into the lives and investment activities of the billionaire class. That's next. This is Bloomberg.
Tomorrow, the Fed decides.
There are credible arguments to cut interest rates. Equally, there are credible arguments to do absolutely nothing.
I think the Fed believes that this is a risk management exercise.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
You wonder at this point how much the Fed is between a rock and a hard place.
There's going to be a lot of hyperventilation about this.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
I'm a little bit worried now, to be honest, what the next days and weeks will bring, in the sense that, of course, we, just like the Ukrainians, want to have peace as soon as possible, but not at any cost. Because certainly if this war isn't Trump's war, which it totally isn't, the peace will be Trump's peace. And I'm sure President Trump is interested in having a lasting peace.
The Finnish foreign minister there speaking to Bloomberg. Now, we're in the middle of the world's biggest wealth transfer as multi-generational billionaires inherit the largest amount in history. Now, meanwhile, a new generation of self-made billionaires is steadily emerging, fueled by success in sectors such as tech and financial services. That's according to a UBS report on the investment habits and concerns of ultra-high net worth individuals. Joining us now is Maximilian Kunkel, the Chief Investment Officer for Global Family and Institutional Wealth at UBS Global Wealth Management. Thank you, Maximilian, for joining us. Look, this is an extremely interesting and important survey that you've put out. What do market participants most misunderstand about how billionaires want to use their money today?
So I think in terms of what they want to do with their money, first of all, they do not see equities being in a bubble that you want to sell out of. In terms of their intentions for the next 12 months, only 3% of the billionaires that we surveyed say they want to reduce developed market equity exposure. In fact, actually, they believe that this is a bull market that you want to embrace. More than 40% want to add to equities. We'd agree, because ultimately what we are seeing is we're still seeing a very powerful rate-cutting cycle globally and earnings growth that is accelerating. The second thing I would say that's noteworthy is exposure to gold. Last year, for example, 40% said they wanted to increase gold, and of course we've had that very significant rally. Now only 3% of them say they want to reduce it. So again, this is something that's quite remarkable about this cohort, because typically it's not that interested in having metals in its portfolio, but rather companies. And there is this continuation of wanting to add to this space.
Maximilian, how are the younger generations actually investing differently? So do you have to advise them differently compared to like 10, 15 years ago? And does it mean more diversification, more into sectors that do no evil, or has that changed in the last 2 years?
So there's obviously a lot of focus on disruption. But I think importantly, this is not just about tech per se and AI per se, but also what is associated with it. And really there's three areas of great interest. The first one is, of course, AI, but here not only focusing on infrastructure, but also increasingly on the application side as we're moving away from CapEx more towards a focus on cash flow. The second one is what are the areas where you are seeing significant disruption and growth as a result also of greater needs for electricity, in part driven by AI. Think the whole electrification. And this really starts from the beginning of the value chain with commodities, aluminium and copper, down to, of course, the data centers. And then the last thing continues to be a focus on healthcare. And I think specifically right now, next to the more structural issues, people are finding a lot more interest here because you have this powerful mix of three things. Policy uncertainty that is coming down, valuations that are still depressed, and of course, the use of technology that can significantly enhance efficiency when it comes to diagnostics and drug development.
Yeah.
And that's an opportunity both in private and public markets.
I mean, how much, I think in some of your latest, actually, surveys, almost a third of 87 individuals commanding 10-figure fortunes surveyed by yourselves are actually looking to cut contribution to private equity vehicles over the next 12 months. How significant a shift is this?
Well, what we are seeing is there's mixed opinions around private equity in terms of funds. We have, on the one hand, as you just noted, close to 30% that say we want to reduce a little bit of exposure. At the same time, we have 37% they say they want to add to private equity funds. What I would generally say is there's a huge focus on the three Ds: due diligence, diversification, and differentiation. The other thing I would note with regards to private equity, finally, we're starting to see an increase again when it comes to private equity direct investments. Close to 50% have said that they want to add to this space over the course of the next 12 months, which is interesting because over the last 2 years, interest was a little bit more subdued due to high interest rates and political uncertainty.
What does that mean, Maximilian, going forward? Do they worry also about AI and AI investing, or does that change in terms of how much they want to allocate in specific private equity funds?
No, I think it's very much about how do private equity funds generate value, and that is in part also through AI rather than financial gearing. So I would rather say it's a mix of what do I actually invest in terms of where does the fund add value or the fund managers add value, and on the other hand, of course, do I already have exposure to this theme potentially through public markets? Remember, if you're focusing on certain areas within AI, you can almost play them better through public markets and you don't necessarily need to add exposure on top in private. On the other hand, of course, you might have some areas that are better played through private rather than public. So there's a big focus on the complementarity between the two, because ultimately for many of these clients and investors, it's public equity and private equity, it's equity. So you really want to make sure that this is complementary.
Yeah. Maximilian, have you seen a lot of your clients actually leave the UK for other places? Are you also seeing, because of taxes and changing regimes across the world, more clients deciding to uproot and move? And what impact does that have on where they want to be invested in?
So what we are seeing is that wealth is mobile. For example, with regards to the billionaires that we interviewed, 36% said they have already moved funds, and 9% are currently considering relocating. Now, this is normally a mix of things that plays in here. The first one is education for the next generation. The second one is a top-notch healthcare system. The third area is the rule of law. And fourth, of course, which in part was very significantly increased as a consideration post-COVID, given the substantial increase in government debt levels, is what are we seeing with regards to taxation. But it's not the only reason out there. The places that are benefiting from this, from what we've seen, and is Switzerland, it's Monaco, in the European area, it is places like Dubai and Singapore in particular.
Maximilian, give me a sense of, so again, looking at the figures, right, of the amount of money that's being given from one generation to the other, their total assets of around $4.7 trillion compared to $4.2 trillion last year. Does that change the psyche on what some of these billionaires ask you?
Yeah, so what we are seeing first and foremost is that a lot of this is not necessarily given to the next generation, but often to spouses. So you're seeing a significant rise in the number of billionaire women. And what is interesting, and it might sound a little bit stereotypical, but we often do see it, is that when it comes to investing, women often tend to be more disciplined and a tad more risk averse. And this is something that we have to take into consideration. So there is more of a focus on building up a strategic asset allocation for a long-term portfolio and then sticking to a strategy once you've built it up, rather than focusing very much on the next best trade idea, which you sometimes may have.
Yeah. Maximilian, thanks so much. Maximilian Kunkel, their Chief Investment Officer for Global Family and Institutional Wealth at UBS Global Wealth Management. Now, the German car maker Volkswagen has been struggling to cope with U.S. tariffs, shrinking sales in China, and muted demand and high costs in Europe. The chief executive, Oliver Blume, has taken steps to find solutions, but the deeper changes needed to make VW more competitive could be slowed down by a family interest in maintaining dividends. Well, joining us now is Bloomberg's Monica Raymond. Monica, so first of all, explain to us exactly what's going on here.
Right. So Volkswagen and Porsche, like much of the German car industry, are really struggling right now. And Volkswagen is in a unique situation because its family owners have an outsized amount of control. And through their holding company, they get a lot of dividends from Volkswagen usually. And the family's interest in continuing to see those dividends and to see those payouts means that they're more interested in sort of maintaining the status quo and maybe more risk averse to making the big changes that are necessary to get VW in a better place.
So will the Porsche family's push for high dividends actually slow Volkswagen's recovery?
So that's the risk that Volkswagen is facing right now. VW has several big challenges to tackle. As you mentioned, they've seen their sales really decline in China. They're facing massive U.S. tariffs on their main Audi and Porsche premium brands. And then they have high costs in Europe and a lot of uncertainty about how the EV market is going to develop. With all of these challenges, we sort of see the potential that the family's insistence on these dividends could stall the bigger changes that they need to make in order to combat those challenges.
So is there a risk that the family's dividends could fall to zero?
No. So it's clear that the Porsche and the PH families are not facing a liquidity crisis. Most analysts and investors that I speak with take the view that the company is going to continue to pay out dividends in some way, shape, or form because the family really insists upon it. It's just that these dividends are really coming under pressure now because of the cash crunch that VW is under right now. They're facing a lot of write-offs and a lot of additional charges, in large part because Porsche has had to make a big strategy reset when it comes to electric vehicles, and they're incurring a lot of charges to make this pivot back into combustion engines, to redo and refit their battery business and investments. So all of that takes money, and that means that the cash flow situation at VW and at Porsche are sort of on edge. What we do know is that the family's stake in their holding company is now worth about $7 billion, and that means it's down by more than $3 billion since Porsche was listed. So we see that the value of the family's holdings is shrinking, is slowly sort of coming under pressure, and the situation in the car industry is making it pretty tough.
All right. Thank you so much for joining us. Monica Raymond there with the very latest on Porsche. Now, recapping a breaking story earlier this hour, BMW's chief executive stepping down next May. The new chief executive has a task of steering the car maker as the industry experiences an uneven move towards electrification. Up next, it's Bloomberg Brief with a full roundup of the markets, of the Fed this week, and, of course, of geopolitics. This is Bloomberg.